You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, Get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO. This Week in Futures Options, a program where the name says it all. We break down the week that was and indeed still is right now from a futures options and indeed a market trading and trending and analysis and volatility and all of those fun perspectives. My name is Mark Longo, coming at you not from our studio in Chicago as usual, but no, from actually our traveling studio down here in scenic and sunny Washington, D.C., where I'm attending the Securities Traders Association 2018 National Conference, a kind of deep in the weeds market structure, all that kind of good stuff. Talking equities, talking a lot of options down here, too, even a little bit of crypto sneaking in. So you can't really avoid that even down here at a securities event. You can't avoid the crypto. So talking all that good stuff. Make sure you stay tuned to the network because it'll all be hitting the network very soon. Some of it could be, even as you're listening to this, could already be hitting the network. So stay tuned. A lot of great content coming from this event very soon. In the meantime, though, let's get to some of the good content on this show and helping me do just that. First off, my cohort, my partner in TWIFO crime, the yin to my collective proverbial yang here, Mr. Nick Howard, the founder of Bantix Technologies, creator of a little platform I'm looking at right now called QuickStrike. Mr. Nick, welcome back to TWIFO, sir. How go things in your neck of the woods?
I'm doing okay back at my desk now, so I could sit and listen to Eric very comfortably while he does most of the talking today.
You put Eric on the hot seat already, huh? Well, that's quite appropriate because he is literally sitting in the CME Group hot seat right now. I am happy to say we are joined once again by an old friend of the show. He's a little bit jet lagged. He's been traveling all over the world for the last couple of weeks, but we're happy to have him nonetheless. He is Mr. Eric Norland, the senior economist over there at CME Group. Eric, welcome back to the show.
Thank you for having me.
And Eric, if you forget your own name or anything along those lines, or if you just fall asleep in the middle of the show, don't worry, we'll understand. You've had quite the hectic global travel schedule of late. And ironically, you're in Chicago right now, but I am not, so we can't be in the studio together. That's a shame. Are you coming to town for FIA in a few weeks? Maybe we can do it then if you're going to be around. I'm assuming you're not because you're already here, but
yeah,
are you heading
I don't
back
think
to London?
Yeah, I'll head back to London, but I should be back in Chicago around MLK Day in January. And, in January, of course, is just a beautiful time to be here in the Windy City.
You have the best travel schedule, sir. They book you in Chicago in January, all throughout Asia now. Interesting stuff. Well, we'll get you back in the studio again one of these days here. I'm sorry we missed it, but we've all been called hither and yon here. The various market forces. Speaking of market forces, let's get into it. I think we have to start with rates, guys, and what's going on. I mean, it is this week in futures options right now, and quite literally, at least today, it's all about rates and their corresponding impacts on the broad equity space. Most of the major equity indices off over 1% right now. We got volatility over there in the S&P, aka the VIX, up over the 15 handle, up multiple handles today. All of that sell-off driven primarily about fear over the rapidity of movement out there in rates. So, Eric, maybe we'll start with you as our guest. I'll give you pride of place. What do you make of today's kind of somewhat surprising sell-off and the even maybe more surprising bleed over that we're seeing from rates? Usually a somewhat staid, kind of quiet sector, not a lot going on, all of a sudden shocking the market today.
Yeah, it's in some ways it's not too much of a surprise to me. There were, I think, a number of leading indicators that people obviously were not paying maybe enough attention to, but that were sending warning signs that we were on the verge of a big sell-off, especially at the long end of the curve in the bond market. And among those leading indicators, I think, were the tightness of credit spreads. If you look at the Credit Suisse Option Adjusted Spread Index or the Merrill Lynch High Yield Bond Index versus Govies, those were trading at just a little bit above 3% over Treasuries. With very, very tight spreads like that, you typically have a very strong economy. If companies can borrow easy and they have very easy access to credit, they tend to hire a lot of people, create a lot of jobs. And that's big news now because we have such a tight labor market with unemployment below 4%, with Amazon now increasing everybody's wages to $15 per hour and perhaps putting pressure on other large and small employers to do the same. I think that we are now in the phase of the economic recovery where things are starting to get hot, and that implies higher interest rates at the short end of the curve, but maybe in the near term at the long end of the curve. So, it wouldn't be surprising to me to see some of these rates moving to challenge their highs from around December 2013, which was the last time. 2013 was really the last time we saw a big sell-off in the bond market. And so if that's the case, it wouldn't surprise me to see even 4% on the 30-year U.S. Treasury by the end of the year.
Eric, this is just more proof that you shouldn't travel or leave the office, because once you do, the market falls apart, sir.
Well, I'm kicking myself because I had been thinking about this a few weeks ago. I was hoping there was time to be able to write a paper about this and get it out. But I was unable to do so because I was traveling. But I think that this sell-off I would guess, is probably not over. I think that it could go on for another month or two.
That won't be happy news for all the bulls out there. Before we get into the equities and some of the other stuff, Nick, you're an old school, experienced rates hound. How does this rate shock spilling over into the equities? How does this feel to you?
Well, Eric's always going to talk more intelligently about the overall market and what it means when we see this kind of sell-off, or why we're seeing the sell-off. I think I can point out some other interesting things outside of that, just sort of related. And Eric probably can follow up with this a little bit, given that it's a CME product. So this week, the CME released the SONIA futures. And it's MPC is the symbol, and that's really tied to the Bank of England. So, it's to see how rates are doing overseas. And it was sort of a kind of questionable in terms of what would happen from a volume standpoint. But yesterday there were, I think, over 6,400 contracts traded. And, a lot of that probably had to do with some of the, spreads just even between the U.S. and the foreign rates. So, when you start seeing, we know that the treasuries and the euro dollars are going to trade, but when you see a new product like that this week, see that kind of activity, that means that there's speculation across the rate market, not just here where our economy is doing so well. And yeah, we have this expectation that it heats up. We're going to see rates get pushed down, but this is even more pushed down. I mean, just as watching, just the futures market itself, it just seems like it's really gotten hit pretty hard, more than everybody expected. But, as Eric said, we probably are in for it a little bit. So not a good time to be long those from an outright standpoint. But Eric, anything that you can add about the SONIA and what that might mean with all that increased volume at the CME? I know it's very welcome.
Yeah, so I think we're very excited about the new SONIA product, which gives people a means of gaining exposure to short-term interest rates in the United Kingdom. I think there's so many interesting things happening in the UK economy. Superficially, the UK economy in many ways resembles the US economy. It has been growing for about 9 years. They also have unemployment in the vicinity of 4%. They are also seeing a bit of inflationary pressure. But unlike the U.S., the central bank there is not hiking rates as actively. The Bank of England has been moving policy rates a little bit higher, but they've been doing it very, very slowly because they have to deal with this whole issue of Brexit, which is also, something that you can, many people will need hedges against, both in the interest rate market and in the currency market. The currency there, of course, had a tremendous response to the Brexit referendum a few years ago. It fell 20%. That 20% drop in the currency was somewhat inflationary. It pushed up British inflation a fair amount, which later on encouraged the Bank of England to raise rates after they had cut them immediately after the referendum. I think if it were not for Brexit, the Bank of England would, or the MPC actually, the Monetary Policy Committee, which I assume is why they gave the SONIA future the code MPC, would be putting rates significantly higher if it were not for the upcoming deadline on Brexit, which is March 31st, 2019, which is coming up very quickly now, less than 6 months. with no concrete agreement between the UK and the rest of Europe. So this is going to be a very, very interesting market to watch.
Yeah, Nick.
I'm sorry.
Ahead.
I was muted. And also, in mentioning the MPC, I did not know that was the short term for the Monetary Policy Committee. But the nice thing about that contract, and there will be a tool coming out to monitor that contract. I think I'm okay to mention something like that. There will be a tool similar to FedWatch coming out that will monitor that activity. But there are SONIA futures, and then there's the MPC contract. So there's, you'll see SONIA, I think it's SON is the symbol, and then MPC. The nice thing about the MPC is those match perfectly. They're set up to match the meeting dates of the Bank of England perfectly. So that trade will exist between meetings. So it'll be one meeting end, and then that'll start up, and the next meeting will come at the end of that contract. So it's really aligns very nicely for people to trade the activity and decision from meeting date to meeting date. Unlike with Fed funds, there's some gerrymandering is the wrong word. There's some finagling you got to do when you're calculating the percentages and probabilities of what's going to happen. But when you're doing that with the MPC futures, because they match the date specifically, it's just really an easy difference between the two futures to start seeing what the probabilities of the change in the underlying is going to be.
Gerrymandering, I like that. You got politics on the brain there, sir. Which is
I got it. I worked it in there.
But since you're talking tools, really quickly before we dive more into the rates, I just want to mention we are getting hit up a lot about the FedWatch tool at CME. It's getting a lot of play these days. Obviously, the Fed very much in the driver's seat. A tool actually that I believe you guys put some spit and polish on, Mr. Nick. You guys and the team over there at the Quick Strike team polishing up the old FedWatch tool. Looking right now here, coming up at the November meeting. If I should clarify this, probably have some people might have some questions looking at this. It says, it says it might be confusing. It says no change, 96%. That doesn't mean no change in rates, listener. That means no change, obviously, in the expectation, which the expectation is for around 200 to 225 basis points for the change, and only about 4% or close to it saying higher than that, so more than 225 basis points. Easing, not getting any love, 0%. So yeah, Mr. Nick, I think your FedWatch tool getting some love these days, sir.
Yeah, I mean, the FedWatch existed at another point. We kind of we rebuilt it and then created all the different historical and probabilities, added the dot plotting and that kind of thing. But when you look at the tool, you're going to see the thatched piece, and the thatched piece is where the current target rate is, and then you'll start to and what you want to look for is you want to see that thatched piece get smaller if you're looking for a rate hike expectation. So you go. I don't think anybody expected anything. They've been pretty clear about September, December being very likely. But you see that if you go out to the December tab, there is more than 85% chance plus 85% of a 25 BIP increase, and then even a small percentage of 50 basis points. But you'll see as you start to move out on these dates, and I think you're really better off paying attention to like the Dec March, kind of doing that alternating dates, Dec March June. It's the futures are telling us rates are going someplace, and not slowly either. So they were definitely going to live up to their expectation for 2018. And then when you start to look way out, even in September of 2019, you have a significantly higher interest rate probability built in to the market, even a small percent of being, almost a point higher than we are right now. So maybe Eric can add some color to that for us.
Sure. I mean, I think that, the strength of the U.S. economy is obviously giving the Federal Reserve latitude to continue raising interest rates. You mentioned their dot plot a few moments ago. The dot plot, basically says that they will hike rates once more in December, which Fed funds futures give around an 80% probability to. And then the dot plot says 3 more times next year. Fed funds futures says only 2 times. And then the dot plot says probably once more in 2020, which the futures market's not really on board with yet. So there's still a pretty substantial gap between what the Fed thinks it's going to do and what the market believes the Fed is going to do. But so long as we have really tight credit spreads, really strong job creation, there is nothing to stop the Fed from continuing to raise rates. unless, of course, we have a really severe correction in the equity market or some sort of flight to quality event that pushes those expectations for interest rate hikes downward and causes the Fed to blink. In which case, of course, they might not do it. But at the longer end of the curve, you have a somewhat different set of issues. The longer end of the curve isn't so much concerned with the current tightening cycle. I think what the long end of the curve is looking at is the exploding U.S. budget deficit. U.S. budget deficit 2 years ago in 2016 was around 2% of GDP. This year it's heading to over 4%. That's a tremendous amount of debt issuance. And the combination of the tax cuts and the spending increases that are producing that budget deficit are very stimulative to the U.S. economy and are actually, the bigger budget deficit in some ways is causing the economy to grow more quickly as the government stimulates it on the fiscal side. But that in turn is very bearish to the long end of the curve, in part because it could be inflationary, but also in part because it means a tremendous amount of new debt supply.
And Eric, you did mention something that I wanted to ask you about. You used the term flight to quality. Is America still the place where people fly for quality in terms of getting the return and not worrying about default? Have we lost our stature at all, given some of the insanity that's occurring over here, or are we still the place to be if the proverbial hits the fan?
Yeah, that's a really tough question. So I think that there's two ways you can approach it. You can either approach it through the currency market. Is the U.S. dollar going to be the beneficiary of a flight to quality? Or you can look at it through the interest rate market. Will the U.S. bond market be the recipient of a flight to quality in the event of some sort of major risk event? So with respect to the currency first, I think generally speaking, yes. The U.S. dollar has been a very strong currency in the last few months, as we've seen a lot of emerging market currencies falling out of bed. Most obviously Turkey and Argentina, but also to a lesser extent some really big emerging market currencies like the Russian ruble, the Brazilian real, the Indian rupee, and the Chinese renminbi, all selling off against the U.S. dollar in the past few months as concerns about emerging markets have been building up. Now, I would add one caveat to that, however, which is that the biggest flight to quality currency is often the one with the lowest interest rates. So if you go back 20 years ago to 1998, at that time, the U.S., of course, had much higher interest rates than we have today that were sort of around 5% at the time. And the only zero rate currency in the world at that time was the Japanese yen. So after the Russian debt default in August 1998 and the LTCM, or long-term capital management meltdown, there was this moment in October 1998 when the market became cognizant of the fact that LTCM and others had borrowed for free in the yen in order to finance positions in a whole array of different assets that were now underwater, and that those positions had to be unwound. The yen rose 15% against the dollar in 2 days in early October 1998. And so right now, the U.S. dollar is losing its status as the cheap financing currency. And that's, of course, creating shockwaves in emerging markets and is somewhat bullish for the dollar in the short term. But now that we have rates up over 2%, the really cheap funding currencies are now mainly the euro and the Japanese yen. So I don't know to what extent others are borrowing in those two currencies to finance or leverage positions. The markets are a little bit too opaque. If people are doing that sort of thing, they don't advertise it. But the fact that you can borrow in the yen and in the euro for essentially zero, or in some cases maybe even slightly less than zero rates, and maybe try to make money elsewhere in the world, could one day set up an explosive rise in those currencies if any funding trades have to suddenly be unwound. Now, with respect to the U.S. interest rate market, the U.S. interest rate market is not typically a beneficiary of problems in emerging markets, unless those problems maybe get really, really out of control. The U.S. interest rate market tends to be the flight to quality instrument in cases of sell-offs in U.S. equities. So if a foreign situation becomes so severe that it causes the U.S. equity market to sell off, as was the case, for example, in August 1998, then typically you see a big flight to quality into treasuries. So far, in the last month or so, the S&P 500, the NASDAQ, the other indices have resisted the selling going on in the emerging markets. They've continued to go higher, grinding to new record highs on some days. It has generally been unperturbed by what's going on in places like Turkey and Argentina. As such, that gives the Treasury market latitude to sell off. But that said, if we had a really big sell-off in stocks, I would be surprised if we didn't eventually see some capitulation on the part of the bond market and have a big rally in price and a big drop in yields.
Since that's why I like having you on, Eric, because you bring us into some areas we don't often have a chance to go, like FX. So let's do just that right now, since we're talking all this currency stuff. Let's start in the big dog, the one everyone likes to watch, of course, the old Euro USD. On a little bit of a down note, it's hovering right around a 6-week low right now, right around 1.15 and a half strike out there, off a little bit again today. Vol, as you might imagine, continues to creep up out there. Maybe creep is putting it mildly, getting a little bit juicy out there, at least from a near-term vol perspective. Looking at where the action was this week, by the way, OI, let's pull up OI numbers here. You can follow along, of course, cmegroup.com/TWIFO. Listeners, OI, I think the term is robust this week, up 11%. So a lot of new opening paper out here in Euro USD. The big action coming in that front week contract that goes out tomorrow. That's where about 27, almost 28% of all the paper was going up this week. And where was all that action? Well, it was front month, not quite at the money, slightly in the money, actually, I should say. Puts right now, the 1.16 puts doing about 5,200 contracts. Surprisingly, not a lot today. Most of that yesterday, 2,000 hitting the tape yesterday, and 1,000 Tuesday, 1,400 going up on Monday. So you'd think today might be a little bit more active, but a little bit quieter, only 800 on the tape today. Then we go out a little bit to number 2, following very closely, pretty much slightly out of the money puts, the 1.15, actually, no, skip that, the 1.16 half. I love the strikes out here, by the way. Calls doing nearly 5,000 contracts, 49.76, taking a number 2 spot. Again, similar story. A lot of paper earlier in the week, only 800 contracts on the tape today, which is interesting. Opening slightly on both of those, the puts and the calls. Then we go back to the 1.15 puts for number 3, about 4,800 of those on the tape. A little bit more active today, about 1,600 going up today. And then a 2,600 going up yesterday. So yesterday was clearly the big driver for Euro USD. Today, not as much, about 1,200 net opening on there. Of course, obviously we don't have today's numbers for OI out here. Nick, we don't get a chance to talk FX that much here on the show. So if anything's catching your eye out here, have at it. And also, I know whenever Eric comes on, you're just full of questions for Eric. So if you got some more of those as well, have at it, sir.
Well, I like when Eric's on because I feel like a student again, and I just sit there with my chin in my hand and listen while he talks, because it's always very interesting, and I learn something all the time. So I want to ask another question, and I'm going to pull up the chart here while I'm asking the question. So I'm going to do like you taught me, Mark, and just kind of elongate my time frame here so I can pull up the data I need in order to ask the question properly. So I've learned quite a bit from you as well with my hand and chin, so to speak. But Eric, if I look at, I'm going to try to go back here. I'm going to go back 5 years. If I look at the pound, okay, versus the dollar, the vol curve has quite a bit of put skew again in it, and I'm looking back to see if I can get Brexit on there as well. So, it's not quite as nearly as crazy, but what are your thoughts on the skew in the pound in comparison to kind of after the whole scare came out of the Brexit stuff? But I do see the curves much different than they looked 3 months ago.
Right. I think the market's really starting to focus on the potential downsides from a no-deal Brexit. which seems to be where we're headed. The Theresa May's government attempts to keep the news media and everyone very optimistic that they are going to reach some sort of deal. As somebody who lives in London and pays very close attention to what's going on and has lived on both sides of the English Channel, I can tell you that there is probably not going to be a good deal coming out of this. Theresa May cannot rally the support of her own political party behind any potential outcome that she can negotiate. But she's having a great deal of difficulty negotiating with the European Union. So today, for example, they've injected a little bit of hope that, maybe she can come to some agreement with Ireland. Okay, that's fine. But then that causes some other part of a potential deal to fall apart. And so I think that the market's really focused on what's going to happen in a no-deal Brexit, which the currency market takes a very, very dim, very bearish view of. Currency markets, you mentioned in the intro that the two of you are sort of like yin and yang. And, I see tariffs in currencies as sort of like a yin and yang. If tariffs go higher on a particular country, typically its currency falls. So if there's a no-deal Brexit, there'll immediately be very high tariff barriers on British products going into the European Union and also into many other countries that have not negotiated deals separately with Britain. And so the logical result of that is to have a weaker currency. And so this prospect, which seemed very real 2 years ago at the time of the Brexit referendum, the market sort of forgot about it for a while since they had this 2.5-year negotiating period. But now that there's only 6 months left, people are becoming very, very focused on it. So it wouldn't surprise me to see the pound at minimum go back and challenge its old lows around 118 or 120, which I think explains why those put options are looking so expensive. And I think that there's a very real possibility the pounding maybe even breaks that to the downside in the event that no deal is going to be reached. And if that's the case, then the pound might even go back and re-challenge its 1985 low versus the U.S. dollar, which was around 105 versus the U.S. dollar. So I can understand why those put options are becoming quite expensive. On the other hand, the call options are cheap because there's just no obvious way out for Theresa May's government in terms of how they're going to negotiate any sort of soft Brexit where they stay in the customs union or anything sort of like a Norway or Switzerland-like model that's going to pass through the Westminster Parliament and is also going to get the agreements of all of the different EU nations that would be necessary to approve it within just a few months. But what I would say is that we may be headed towards an incredible buying opportunity on the British pound. If the British pound does get below 120, and especially if it gets down to around 105, this may be the ultimate buy on the, sort of sell on the rumor, buy on the fact sort of trade. And maybe that the pound gets to a point that's so oversold that no matter how bad Brexit is, it couldn't possibly be worse than what the market is pricing. So if the pound continues to fall to new lows, especially if it breaks through its recent lows and the put options are still extremely expensive, there's going to be a really, really interesting trading opportunity. But we may have to wait about 5 or 6 months to really see that come to fruition.
That's interesting. You mentioned kind of a no way out for May's government there, which some people do kind of whisper or hint at the notion or maybe the possibility of even just doing the whole thing over, doing another vote. Do you see anything along those lines shaping up, Eric? And if so, what do you think, what impact do you think that would have on what we're seeing out here?
Yeah, so if there were to be the possibility of another referendum, that could also produce a tremendous rally in the British pound. And so there are a lot of very powerful, very well-connected people in Britain who are pushing for that, including most prominently John Major. John Major is, of course, the little-remembered prime minister who was prime minister for nearly 7 years, actually, after Margaret Thatcher left and before Tony Blair came in. But he is pushing for it very hard. I believe Tony Blair is also pretty actively advocating for a second referendum, as are the Liberal Democratic Party, who are, a smaller third party with about 10% of the vote. But the problem is that Theresa May and her government are not on board with this idea. There are a faction within the Tory party, within Theresa May's party, who would like to do that. But there are a small minority within the party who really want another referendum. So I think it's going to be hard to organize, and especially hard to do between now and March 31st. So it could be that maybe the EU and Britain agree to an extension, and then during an extension of negotiation period, then there could be time maybe for a referendum. I would not rule out the possibility of it. But for the moment, it's not looking like it's going to be something that's going to be happening in the next few months. I think that we really have to get into next year before any discussion of a second referendum becomes really serious, if it becomes serious.
So just to follow up one more thing, you mentioned the cheap calls. I mean, and you mentioned 5 to 6 months. I mean, does that mean a trading opportunity is already there? Like what I always look for is what's the cheapest part of the vol curve, and even though we're still a ways away from actually getting any kind of closure or expectation of where this might go, it would seem like there's some long volatility plays, even hedged long volatilities up in that in the upper strikes. Find the cheapest stuff, hedge it, and wait and see what happens. Because if you continue, if there's a shock and you go up, you're in good shape. You'll get a bid, and if there's a continued bearish sentiment and things move down, you have some cheap volatility and some futures against it that you might be able to trade out of rather easily. So that seemed like, and I know you can't necessarily give option play advice, but I mean, do you see it getting cheaper? I guess is my question there for the upside.
Well, yeah, I think that there's a lot of interesting things you could potentially look at. If I had to guess how it's going to turn out, I would guess that we're probably could see significantly higher volatility than where we are now. So I don't know that. I think that the currency itself, which is currently trading still around 130 versus the U.S. dollar, could go a lot lower. It could easily re-challenge as lows at 120, maybe even go down as far as 105. But if it starts moving that big, I think that implied volatility has a long way to go on the upside. So there's a lot of interesting things to explore along that vol curve over the next few months.
Eric, I'm going to let you play a little bit of dealer's choice here next, because we've already been going for quite some time and we've only covered FX. That just goes to show this show needs to be like 5 hours long. There's so much to talk about, especially on a week like this. There's a lot of things lighting it up. I know you personally have had a lot of interesting research coming out as well. So I'll let you choose where we want to go next. Do we want to go into the metals? I know you've been talking a lot with gold and aluminum. Crude has been lighting up again this week, hitting more new highs recently out there in crude land. We've seen the equities selling off, some of the recession research I know you've been doing out there as well. So I'll let you, as our guest, pick our next area. Where should we visit, Nick or Eric? Should we go equity? Should we go crude? Or maybe you want to do a little bit of metals?
Let's do a little bit of metals.
How did I know you were going to go that way? I know you still love that well-timed, what was it called? Gold storm on the horizon, correct? That's what
right.
One of the most well-timed research reports I've seen in the modern era, sir. I still cling to that. That was a good one. So yeah, you have some history with gold. Let's get into it then in the metals. You of course have some interesting research you've been doing out there as well. It's called Gold Waiting for the Next Bull Market. I think that's a pretty fair way to sum up what we've been seeing out there. That's certainly the way the gold bugs have been playing of late, right? Because there's not a lot of upside for them to fall in love with. We all know the gold bugs are shall we say, some of the more vociferous of our listeners and of the users out there. I know you've encountered this yourself, Eric, whenever you dare to put out a report that may cast a bearish light on gold. They'll come at you. They're a hardcore bunch. So looking at there right now, we're seeing obviously the COMEX gold actually up a little bit on the week, up about 5 handles. Still hovering right around that 1,200 level, that kind of magical, mythical level it's kind of been vacillating about for some time. Gold vol, Eric's previous report notwithstanding, has kind of been in the doldrums for a while. Whenever it catches a bid, it can't really seem to sustain it. Catching a little bit of a bid this week, so we'll see if this is sustainable or if it plays out like more what we've seen out there in gold vol, where it gets a little bit of life and then it kind of comes back in. Even though Mr. Nick's been loving his hedge push with futures, I'll let him get to that in a little bit too. But Eric, let's kick things off. I know you just put out a big report on gold. So what's catching your eye out there from a metals perspective, sir?
Well, gold has just had such a tough time over the last few years. And I think the reasons why are pretty simple. It really boils down to three things. First, gold mining supply has been increasing, which is somewhat bearish. Secondly, the fact that the Federal Reserve raising interest rates and expectations that they will raise rates further, also not great for gold. And then lastly, the strength of the U.S. dollar against other currencies actually seems to be the biggest factor, the factor with the strongest correlation. Gold has been showing a correlation with the U.S. dollar index, which is mainly an index versus European currencies with some other currencies thrown into it, of around negative 0.6 on a day-to-day basis over the last year, which is a very, very strong correlation. So the strong dollar is not good news for gold. But my thinking is this kind of rough period for gold might persist for a while longer because obviously the Fed is still raising rates. There's a lot of potential downside on foreign currencies like the euro and the British pound, as well as on some of the emerging market currencies, as well as the Fed continues to hike rates. So I'm not saying that gold is necessarily going to rally in the next 12 months, but I think as we look ahead to the 2020s, which I know sounds ridiculous because it sounds like it's so far off, but the 2020s actually begin in just 15 months, which is scary to think about, but nevertheless true. And so when you look ahead to the 2020s, what's going on? Well, the Fed's probably over-tightening policy. I think that they're tightening policy way too much. I think that they are likely to move too far and eventually push the U.S. economy into a recession. I think that the rest of a recession in 2020 is maybe not too high, maybe around 30%, but maybe around 2021, maybe a 50-50 chance of a recession or even higher if the Fed continues to hike rates. And so if that happens, what does the Fed do? Well, the Fed immediately has to cut rates, I think maybe back to zero, which would be massively bullish for gold. And then secondly, we have this phenomenon of an expanding U.S. budget deficit. Bigger U.S. budget deficits often eventually drag down the dollar. And what's particularly weird about this is the budget deficit has actually doubled in size over the last 2 years, even as the economy continues to recover. So imagine if we have a downturn, our 4% of GDP deficit could easily become an 8% of GDP deficit, in which case I think the dollar could go through a very, very weak phase in the 2020s, in the early 2020s. And that could also be massively bullish for gold. So I think the gold could remain in the doldrums for another year or so. It's very hard to say. Obviously, it's a volatile market. My guess is it'll probably trade in its range from 1050 to 1350. So right now we're kind of smack in the middle of that range. But into the 2020s, I think that the conditions are going to be ripe for another massive, massive rally in gold that could very easily push us back towards the 2011 highs or maybe even higher.
You know, you're right on several levels there. First off, Eric, you're right. It does sound strange to say 2020. It sounds like you're talking about some ridiculous date in the sci-fi far-flung future, and yet it's only a year and change away, which is terrifying in and of itself. But also, you're right too. I've been kind of hearing some whispers about that. I've kind of been wondering this myself. We're hearing all this talk right now. We just talked about it. What the Fed Watch tool is talking about. The market is pricing in multiple raises over the course of the rest of this year and into next year, of course. But also, if you start looking at the longer term indicators and surveys of asset managers, they're also starting to predict a recessionary trend kicking in maybe second half of 2019 into early 2020. So we may have this weird scenario where we raise ourselves close to or right into a recession, and then we start selling off again. And then sure enough, maybe we start climbing right back down rate hole that we just started climbing up again. And of course, into 2020, I don't know any brave Fed that's going to raise do a lot of raising into an election period like that. So it might be a weird cyclical scenario we find ourselves in, where we raise ourselves up and then we sell off in the broad equities, and we find ourselves maybe going right back down the curve. Mr. Nick, I know you like to watch yourself a little bit of the shiny stuff as well. What's catching your eye out there? How are your hedged puts with futures looking? And are you buying this too? Maybe that we're going to raise ourselves right into potentially something recessionary, which will cause us to maybe run right back down the rates curve again.
Well, I mean, I think I always defer to Eric in terms of what he thinks is going to happen over the long haul, but it would make sense that they're going to continue to raise until it triggers us going the other way. I think my comments are more along the line and just my personal thoughts on gold. And Eric mentioned the range of like 1050 to, we'll even call it, I don't know what you said on your high side. I was more concerned about what you were saying on your low side. But, you go back and you look at the rolling front contract, we did bounce off the 1050, and that was in late 2016. But we came right back off that. So I would, again, me just speculating, am I looking at, and if I go back in the beginning of the fourth quarter, or maybe the end of the second quarter in 2016, we were probably around the 1080 mark. So, if you don't look at that as the low, I'd say our range is even tighter than where it is. And what I think with gold, just in general, it seems like a really good period of time for accumulation. Now, obviously, it's tough to do that from a future standpoint, right? I'm thinking even from just generally physical. If you feel that it's in a range, the lower part of I'd say it's near the lower part of our range, just based if I cut off that 1050. I like general accumulation here of gold. And to make a comment about the puts that we talked about, I remember, I think 2 or 3 weeks ago, I said no to that strategy, and then last week I said yes, given where we were and how I felt the bottom of the range was. And that play actually, in this week, moved up to the point where you could have hedged and then gotten out and scalped and getting on those puts for zero. So, I mean, do I like it still? I haven't looked today so much. I like it as we dip a little bit lower below the 1200 level. But I do like gold I like hearing Eric say that there's the upside potential is great, especially because I feel like it's a good time for just physical accumulation of this, or even the ETF, the IAU. It appears just a good price to get in, as far as I'm concerned.
Eric, you on board with that, or is that all just complete utter heresy to you, sir?
No, I completely on board with that, and I agree that the 1050 to 1350 is an extremely wide range. But yeah, I think you're right. The actual trading range for gold recently has been much, much narrower than that, and that's reflected in the fact that we have options on gold and silver, for that matter, trading near record low implied volatility.
I want to do a little quick crop dusting here through the magic of Quick Strike, so we can hit on some quick options activity, because we are coming up against it, and I want to make sure we get a couple of more categories in here. I'll do really quickly. I'll just stick with the number one hot options out here for these different products. We don't even have time for the top 5, I don't think. If you're talking out here in gold land, you're actually talking, I said we're right around the 1200 level in gold. 11.5 puts taking the number one spot out here in November, with about 4,500 of those lighting it up on the tape here this week. Again, I mentioned some headlines out here in crude. This is one of the few weeks we didn't have time to do a deep dive in crude. So let's go through the magic of Quick Strike. Listeners, you can do this yourselves, cmegroup.com/Twifo, or just head on over to bantix.com. That's BANTIX.com. Click on the Quick Strike login, or try the trial link if you haven't done so yet, and you can see all this stuff for yourself as we're pulling up here the top strikes out here in good old Quick Strike land as well. Pulling up, if you're looking for energies, go to the drop down, go to energy, go to WTI American, and then you will find all this good stuff. And of course, as I say that, I'm having all sorts of Wi-Fi issues here in the remote studio here, which is dramatically slowing me down here on the Wi-Fi. So I'm going to come back to the crude in a couple of seconds, but I want to roll on really quickly here. Eric, I know you've been doing a lot of research in. Oh yeah, sure. You want to hop in?
Can I pop in one more thing? I'm sorry, I didn't know if I don't think you can mute me when you're remote, so maybe I should. Hey Eric, can you I just pulled this up because Mark, when we mentioned silver, I know that we talked about it a few weeks back, but that gold-silver ratio hit its peak not too long ago, and now we've seen substantial move higher in silver over the last, 9/17. Yeah, probably mid-September, we hit like 85 on the ratio, and now it's back down to like 81, 82. So can you talk to that a little bit and why that? That has 85 has been sort of that long-term high for quite a bit of time. Can you talk a little bit about that and why that might have occurred?
Yeah, I think there could be a couple of things. I mean, for one thing, silver has been generally selling off again gold for most of the past 2 decades, and so part of that is that silver lost its main industrial use, which was photography. So as photography used to be 25% of silver usage, now very few people, of course, still have photos developed. So now it's just a few percent. So that's been terrible news for silver in the past. But the good news is you can only die once, at least so far as we know. Now that photography is silver plate photography is definitively dead, we don't have to worry about that anymore going forward. So this idea of silver being a weak metal and weaker than gold, I think may be an idea of the past. The other thing is silver actually has more industrial uses than gold. Gold has almost no industrial uses at all. It's a very small percentage of it gets used in industry, where silver a bit higher. So anytime you see strong numbers out of China or out of other markets, silver tends to outperform a little bit. And then also lastly, if you kind of view silver and gold, just to borrow a term from the equity market, silver is like the high beta version of gold. So gold bounced off of its lows recently, and silver bounced more. So typically, silver is about 1.25 times as volatile as gold. And so, if gold prices go up 10%, silver prices usually move 12%. So the fact that we saw a little bounce up in the prices may have pushed that ratio a little bit as well. I think that the gold-silver ratio is sort of unjustified in terms of, the relative level of mining production, for example. If you look at how much silver is mined versus how much gold is mined, the ratio is just way, way out of line. So I think that silver has a lot of upside potential versus gold in coming years.
Really quickly, my Wi-Fi finally kicked back in here, so I'm able to pull up the quick strike page. You guys, again, mentioned, can do that yourself on those links I mentioned earlier. And if you're wondering what is cooking in crude right now out there in WTI with the options, we're hovering, hit that 75 plus level this week, hovering right around 74.5 right now, coming into showtime, up about 1.5 handles net on the week. And if you're wondering what was lighting it up, it was the 70 puts out there in November, taking the number one spot with 42,000 contracts out there this week. Vol also up, as you might imagine, getting up into this rarefied air that's going to breathe a little bit of juice, a little bit of life into the vol. Maybe it might be sustainable if we stay up here for a little bit. We shall see. But in the past, crude vol has been kind of like gold vol. If you don't sustain the move, it kind of comes off. But since we're hitting into this kind of not quite uncharted, but recently uncharted territory out here in crude land from a price action perspective, we may see that vol stay here to stay. If you're on the bull side, though, not to be discouraged, the 80 calls out here in Dees also active with about 30,000 contracts this week. So maybe a little bit of a ratio strangle. 70 puts in OC 43,000 times, 80 calls in 70 puts in November, 80 calls in December, about 4x3 going up there this week. And let's end up here. Our friends Sean couldn't make it this week. Our friends at Russell couldn't make it. I'm sure our producers there in the studio miss them in Chicago right now, because whenever Sean shows up, he usually brings delicious gourmet burgers, which they would certainly appreciate there. I wouldn't mind one here as well in DC. But Eric, I know you've been doing a lot of interesting research out there on the equity land as well. In particular, some of the recession hallmarks. You've touched on a little bit of this earlier in the show, but what are some of these warning signs you're seeing out there right now in the equity land that maybe have you a little bit concerned?
Well, I think there's a few things to look at in terms of equities. One thing is that as this rally ages, and it's a very, very old rally now, 9.5 years, it'll be 10 years in March if it makes it that far, which I think probably will. That as it ages, it becomes a very narrowly focused rally that's really mainly focused on technology stocks. Now, along with consumer discretionary, and a few other areas of strength. Healthcare is doing okay, finance is doing okay, but there's a lot of laggards out there that are really underperforming. And so, typically in the early stages of a rally, everything goes up together. All of the different industry groups participate, and as the rally goes on, they typically become narrower. And so we're kind of getting into this very narrow rally that in some ways reminds me of the end of the 1990s, those last few years when it was really dominated by technology stocks that were really taking the market a lot higher. So that's one thing that kind of concerns me. And especially when you look back at the late 1990s, there were really two main features. There was a technology stock rally and an emerging market currency crisis. And so now we have both of those factors at play again. Another thing that concerns me a bit about the equity market is the, oh gosh, I lost my train of thought here. Just give me a moment here while I think about it. But another thing that concerns me about the equity market was, oh yes, the other thing that really concerns me about it is in the early stages of an equity rally, you typically see corporate profits go higher and equity prices go higher, which we have seen happen this time between 2009 and 2014. But since 2014, corporate profits haven't really grown very much, and yet equity prices are soaring. Now, a lot of people might say, hey, wait a minute, aren't profits a lot stronger now in 2018? And the truth is, yes, they are. They've rebounded a lot. The tax cut has certainly added a lot to corporate profit margins after tax. But that's kind of a one-time deal. We had a pretty serious dip in earnings in 2015 and 2016 with the crash in commodity prices. So now I think we're entering into this late stage of a rally where earnings are probably going to start declining from here on out as wages increase, as we saw with Amazon, hiking wages to $15 an hour for their lowest paid employees. In a very, very tight labor market, it's going to put a lot of upward pressure on wages and downward pressure on corporate profits. Likewise, at the Fed raising rates, that also puts downward pressure on corporate profits. And I think the combination of those two things will put corporate profits in a pretty bearish orientation for the next few years. That does not mean, however, that the stock market is going to peak imminently. Corporate profits fell between 1997 and 2000, and the stock market rose anyway. Corporate profits fell in 2006 and for the first, all throughout 2007. And the stock market didn't peak out until October 2007, about a year and a half after the peak in corporate profits. So if corporate profits start dropping, say, starting this quarter or next quarter, and they start falling through 2019 and into 2020, the equity market could still work its way higher, but I think it becomes a very dangerous late stages of a rally that may give way to a big, big bear market in the early 2020s. And much higher volatility.
All right, I feel bad. I always feel bad whenever we don't get to the listeners. So I know we're coming up against it, but I want to get a couple of them at least here in on the show as well. We want producers back in Chicago. We don't even worry about we don't even have time for the transition. Let's just dive right in. Let's see what we got here. First up, Eric. Actually, this is a good one for you. Good thing you're on the show. This is from Leo Orland. He wants to know what is the base mining production cost for gold? Are we approaching that level? I don't think we're near quite that level of the downside. But I know Blue has talked about this before on the show, kind of doing. I think maybe you have as well, Eric, kind of looking at what the kind of net factors that drive that net mining cost. So maybe refresh our friend Leo here's perception of where that level is, Eric.
Right. So there's two key numbers to keep in mind. There's the cash cost of gold mining, which only looks at the operational cost of the mines. That's really around $700 per ounce. So we're way above that. The gold mines still kick off a lot of cash, but then there's the all-in sustaining cost of gold mining, which includes all of the company's overhead, investment in new mines, et cetera. And that's probably around $1,200 or $1,300 an ounce. So at the current price, there's not a lot of incentive to be investing in new gold mines. So that's probably somewhat bearish for gold supply over, say, the next 6 or 7 years. But it's not necessarily bearish for gold supply over, say, the next 6 or 7 months.
All right, Nick, you don't feel left out too. I got one for you here. This comes from Tatless. I like that handle. Tatless. He says, I love vol views and Twifo. Well, thank you, sir. He says, I missed the twofer Fridays with both shows. The days when we used to do vol views and Twifo kind of back to back on Friday. Now we do option block and Twifo back to back on Thursday, Tatless. So you're not left out. He goes on to write, keep up the crude info. Have a somewhat basic question. He wants to know, Mr. Nick, can he trade options on WTI Brent? He means the spread, of course, or just the futures? Thanks again. Mr. Nick, what do you got for him in Quick Strike, sir?
Well, definitely there are WTI Brent intercommodity spread options. And if you recall, maybe you came on after, but there was a big period of time when that spread was just after the election in 2016, that spread went to zero, and there was some major volume in the zero strike, pretty much out to where we are right now, I believe, is where it originally were traded, as far out as it traded, I think, and I could probably verify that by looking at what the open interest looks like on that particular. We got the -10. Yeah, so we have. I look at the D's contract. There was 40,000 open interest that traded right after the election. And we also have similarly about 40,000 of the -10 strike. So we've had some real extremes in the last 18 months to 2 years in terms of that spread. So yes, there are plenty of options that trade out there. There is open interest in 1, 2, 3, 4, 5, 6, 7. The first 6 contracts, and let's go to June and December here. I'm going to say there's probably more. So you probably have a fair amount of open interest in up to 8 contracts. So the June D's in the deferred years definitely have some open interest for trade. And there's 200,000 open interest overall and a 1% increase this week. That tends to get spotty volume, right? We got a lot of that 00 strike trading, like I said, after the president was elected and talked about the tariffs and all that kind of thing initially. And now we saw the -10 as well, which I believe at some point we talked about with blue, even where the -10 in that spread was really sort of the bouncing point for things. I think it might even trade at 11. So yes, they're out there. The liquidity is probably pretty good given that there's 121,000 open interest in the December contract, which has almost 30 days to expiration. So yeah, there's plenty out there for you to trade in the spread.
There you go, sir. Well done. We'll wrap it up on this one. I'm being generous. I'll squeeze one more in because I love the listeners. This is a perfect one for you, Eric. This one came in earlier this week. It seemed kind of silly. Now with today's action, maybe not so much. This comes from 10761. He just wants to know very simply, are we in the midst of a major correction? Mr. Eric, what do you have to say here for our friend who clearly is a little concerned?
Well, a major correction for fixed income or for equities, or?
He doesn't specify. I'm assuming he means equities.
Oh. Well, I think the equity market might be a little bit overdue for a correction. It's been doing so well, ever since it fell out of bed in January and early February. It's been doing incredibly well. So it may be a little bit overdue for a correction. But the correction I'd be really concerned about in the next few months will be that at the longer end of the fixed income curve, which seems like it's broken some really important support levels and also has really bearish fundamentals, at least for the next few months. Now, of course, the possibility of higher long-term interest rates might cause some equity investors to say, hey, what are we doing with all this risk in our portfolio when we can get, say, 3.5% or maybe eventually 4% yields on our 30-year treasuries. So that could cause a flight away from the equity market and into lower risk assets. But I think that the correction I'm worried about is really the treasury market more so than the equities, although the equities may be overdue for some sort of a short-term correction.
They'll have to leave it there, listeners. Glad we could squeeze at least a few of you here onto the show. Keep those questions coming. We do love to hear from you. But I already kept these guys too late, so I won't hold them. Eric needs to go to bed, so we'll let the man go. But before we go, let's go back around the horn. Eric, we'll start with you. Obviously, we hit on a lot of your research already. Any interesting hints, any interesting teases on what you're working on coming down the pike, sir?
Oh, well, I think we have some pretty good research coming out on the expansion of the U.S. budget deficits and what that means for interest rate products. And I think we'll have a bunch of new research coming out on Europe as well. Where obviously has very, very fluid political situations in the United Kingdom and also on the continent, in Italy in particular, but also in France and in other countries.
And Mr. Nick, same question for you, sir. You guys are always cranking away new cool tools, new cool functionality over there in the land of all things striking. That is quick. What do you got cooking for us this week, sir?
Like I mentioned all along, there'll be some new tools getting loaded on the CME Group website. So keep an eye on those. I can't say anything about them until they're getting out there. You've seen some shape or form of them in QuickStrike already if you're already a user. So look for 2 or 3, even 4 new tools, maybe 5 new tools coming out real soon and during the time frame of this quarter. And also we'll be releasing some neat new features within QuickStrike where you can have multiple windows open at the same time without having to flip back and forth, to be able to have different product tabs and that type of thing. So we're excited about getting that out there as well. So CMEgroup.com/QuickStrike or Bantix.com, BANTIX.com. Learn more. Free one is on CME Group, and subscription version is out at Bantix. So take a look. If you got any questions, just tweet at us or shoot us a note. Glad to answer.
Super secret new tools. You heard it here first. I'm not. You piqued my interest, Nick. I'm very curious.
SSNT.
Super. That should be your tagline. Super secret new tools. You got the cone of silence over there, QuickStrike. I'm looking forward to seeing. I'm sure I've seen some of them, and you users have probably as well, and QuickStrike listeners. But I'm looking forward to seeing them getting out over there. Like Nick mentioned, the free version. Want to kick the tires? CMEgroup.com/Twifo, or indeed head on over to Bantix.com, BANTIX.com. If you're ready to put on the old big boy pants and try out the tools for real, that's the place to go. And last but not least, like I mentioned, our buddies couldn't be here from FTSE Russell. Check them out, FTSERussell.com. Check out all the great data they have coming out and all the great analysis, studies, active versus passive in the equities, volatility, all that good stuff. Of course, give them a follow while you're over there at Wealth, FTSERussell.com. Give everybody a follow. You probably already follow CME. Maybe you follow Nick as well. If not, QUIKSTRIKE1 over there on the old Twitter machine. And on behalf of Mr. Nick and Eric and Sean and the FTSE team, and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing, for sending in such great questions. Keep them coming. We'll have to do another all Q&A episode soon because those are pretty fun. Otherwise, we'll see you next time for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.